I'm going to use the handrail. No, go ahead. You come on up.
Thank you, Nancy. That was a really fantastic discussion. So before I introduce our next speaker, I just thought I would give you guys a sneak peek into what's coming up later in the day today. We have a very exciting fireside chat with Subra Iyer. Subra was the founder of WebEx, and I'm sure all of you have used WebEx at some point. And he sold it to Cisco for a cool $3 billion. So it could be a very interesting discussion, and he's going to talk about his new venture as well as how to be successful in Silicon Valley. So don't miss that. And there were questions on blockchain, and we actually have a panel discussion coming up later in the afternoon on blockchain and payments. So make sure you don't miss that either. So now it's my pleasure to introduce our next speaker, Ron Shevlin. Ron is the Director of Research of Cornerstone Advisors, where he heads up the firm's research efforts. He's the author of the book Smarter Bank, the Snarketing blog, Cornerstone's Insight Vault site, and the Moment of Snark on the Breaking Banks radio show. Consistently ranked among the top fintech influencers in the US, Ron has published more than 150 reports and studies on consumers' banking behaviors and attitudes, and on the impact of fintech in financial services industry as an analyst at Cornerstone, Forrester Research, and IT Group. Ron is going to talk about NeoBank and digital banking future. Welcome, Ron.
But thanks, Patty, for having me here today. I appreciate this opportunity to share some thoughts with you guys on what's going on from a NeoBank perspective. It wasn't that long ago. It's been about 10 years now since the financial crisis. And it's been an interesting 10 years in banking, don't you think? It wasn't that long ago that pundits and experts were predicting the death of banks. And we were seeing books with titles like The End of Banking or Bye Bye Banks. Now, to be fair, it wasn't all doom and gloom. At least these guys put a question mark at the end of the title of their book. But what these experts and pundits got wrong was that it's not banks that are dying. Last year, JP Morgan Chase generated more than $24 billion in deposits. Back in 1994, Bill Gates said that we didn't need banks anymore. Meanwhile, Microsoft didn't generate a lot more than $22 billion, so take that, Microsoft. But what the pundits didn't get right is that it's not the banks that are dying. It's the traditional financial products themselves. And while I'd venture to guess that every one of us in this room has a checking account, the reality is that checking accounts have basically become paycheck motels. Temporary places for our money to stay before it moves on to bigger and better places. So let me give you some examples of why this is happening. More than 22 million Americans have a health savings account, and by the end of this year, there'll be more than $44 billion sitting in those accounts. Now think about where that money's coming from. It's coming out of checking accounts. In fact, it's not actually coming out of checking accounts. It's going into health savings accounts before the money even hits the checking account, because now we've got the money automatically flowing during the payroll process. There's other examples of this as well. I know you've heard a lot about Venmo in the past couple of years. Well, actually, before I get to the Venmo example, what the health savings account is an example of something I'm calling deposit displacement. The diversion or the displacement of funds away from traditional checking accounts into alternative types of accounts. And what this trend is doing is helping to diminish the importance of checking accounts in the lives of consumers. So now let's talk about Venmo. You've heard a lot over the past couple years about the volume of Venmo and how many users it has and how many transactions they do. But what you might not have heard is that Venmo users have more than $2 billion just sitting in their accounts. Money that used to be sitting in their checking accounts. And that's not the only impact of P2P payments. I'm sure, as you know, Apple's P2P service basically doesn't put the money back into a bank account. It keeps it in what's effectively an Apple prepaid debit account. The impact or deposit displacement from P2P payments is going to far exceed the amount of money sitting in Venmo accounts or even Apple accounts and even Square accounts. End of last year, I surveyed consumers, and I asked them how likely would they be to use a general use debit card if one of the following P2P providers offered it. Nearly half of millennials said that they would not only be very likely to use a debit card from PayPal, but that they might even make it their primary account. About a quarter of consumers said that, or millennials said that about Apple and Google, and 1 out of 5 said that about Venmo. Now listen, I'll be the first to tell you that consumers never do what they say they're going to do when we survey them, right? But even if a quarter of the people who said this actually used these cards if they were offered as their primary account, we'd see not only a huge amount of deposit displacement, we'd also see a lot of payment displacement in terms of interchange funds that the banks are generating today. Also seeing a lot of deposit displacement from the merchants themselves. Anybody here have the Starbucks app on their phone? A lot of you got money on the account? Probably do. Money that used to be sitting in your checking account. Conservative estimate is that Starbucks has got over $2 billion in deposits. When they actually reported that number 2 years ago, it was about $1.5 billion. It has to have grown to more than $2 billion by today. I actually think that's a conservative estimate. I think it could even be more than that. And now other merchants are beginning to learn that the Starbucks model of having preloading up the funds, reducing the interchange that way is the way to go. But from a consumer money management perspective, it's just money that's moving out of the checking account into some other account. Nancy also mentioned the robo-advisors. Consulting firm A.T. Kearney estimates that by 2020, robo-advisor assets will reach $2.2 trillion. Now, that may be a great business opportunity for a lot of you, but for the banks, this is a threat as well. Because Kearney estimates that about half of that, $1 billion, is going to be shifted from deposits. So what you're seeing in the market is deposit displacement, the diversion or displacement of money from traditional accounts like checking accounts into alternative accounts. Checking accounts have become paycheck motels, temporary places for people's money to stay before it moves on to bigger and better places. So when we look at this from a neobank perspective, the reality is that this has not created many opportunities from a neobank or digital bank perspective. Reality is that the neobanks like Simple or Movin have simply not reinvented the checking account. They're simply trying to create a new bank without branches, but that's not what's happening from a consumer perspective. Consumers are looking for better places to manage their money, not simply a bank without branches. And now you've got some of the large banks coming out with their own digital offerings. Chase in the past couple of months has launched Fin. Just a week ago or so, Wells Fargo announced their digital bank called Greenhouse. The woman who runs Greenhouse was quoted in SNL as saying that the app's target audience is younger consumers and students who are new to banking and learning about personal finance and budgeting. Just 2 weeks ago, I surveyed consumers, asked them about their fintech adoption, use, and awareness, and broke this out by generation. And what I found is that among consumers who have already has or would consider opening an account with a neobank, the greatest interest in the neobank, digital bank offerings are not from those young consumers. Only about 3 out of 10 young millennials, those in their 20s, said that they already have or would even consider opening up an account with a neobank. The interest is from older consumers, the older millennials in their 30s, and even more so, or more so than the younger millennials, the Gen Xers, who are in their 40s and even early 50s at this point. And forget us baby boomers, we really don't care about fintech at all, so you can ignore me and the rest of my generation. And apologize, I couldn't really find a good picture of a neobank, so I had to go with Keanu Reeves' Neo from The Matrix. I'll find a better picture someday. Now, so there's one opportunity that's being missed from the neobanks, is they're focusing on this younger consumer that's not where the market is. The other thing that's impacting the neo or digital bank opportunity is the platformification of fintech. Now, when I use the term platform, I'm not talking about it from a technology construct. I'm sure many of you who are coming from fintech startups think of your offerings as a platform. Everybody thinks they've got a platform. I'm using the term more as a business, from a business model perspective. A plug-and-play business model that enables buyers and sellers to connect interact, create, and exchange value. And to fulfill a platform business model, you need three capabilities. Number one, you must be a magnet. You have to attract both buyers and sellers. Banks today aren't really platforms. They do a good job of attracting buyers, consumers, customers, but they don't attract other providers to their offerings. So they're not really satisfying the definition of a platform. Second capability is being a matchmaker. You have to match the providers and the sellers on your platform. And the third capability that's required is you've got a toolkit for integrating the buyers and sellers on your platform. And of course, there's no better example of a platform in the US than Amazon. But it's interesting to see how Amazon has evolved over 20 years. When they first started out in the mid-90s, they was really focusing on building out the magnet capability, mostly by selling books, by becoming a B2C e-commerce website with some matchmaking capabilities. But by around 2007, 2006 timeframe is when they launched Amazon Web Services, which was really the toolkit for integrating buyers and sellers on their platform. And then around the 2011-12 timeframe is when they really kicked into the platform strategy as they saw their valuation rise. That was $860 billion last week. It's probably down to something a little bit lower these days. I can't keep up with the track of that. But this is the platform, what's happening in banking as well. And so from a fintech perspective, there are three things that are impacting the neobank or digital bank opportunity from a platformification perspective. The first is the mega banks with their API toolkits. The second are the transformation of the marketplace lenders to becoming platforms. And the third is the rise of new types of fintech providers creating fintech vendor platforms. So let me quickly give you some examples of what's going on in each of these three areas. Many of the large banks have created their API toolkits or their API platforms. Interesting, BBVA calls theirs open platform. It's a misnomer. There's no open banking really going on in the US. We can debate that later if you'd like. Interestingly, despite how I tend to poo-poo Simple and what they've done in the market, BBVA does like to highlight them as their example of open platform and API. But basically what they're doing is building out a bunch of APIs to enable other players to access data and integrate in. So far, not much in terms of a business model change, but I think that can evolve over some time. We'll start to see more change in that. But this is the first step from the large banks getting into the platform space by starting by actually building the toolkits first through API development. And speaking of APIs, I hope you'll all be at the networking event later today. My understanding, I saw them sort of loading up the trucks. They're actually going to be serving APIs at the networking event this afternoon. No, it's true. Whoops. APIs, they're going to be serving APIs at the networking event. So I'll be looking forward to that. Second trend is the marketplace platforms. As the economy improved in the past couple of years, the whole market underlying the marketplace lenders like Lending Club and Prosper changed to the point where they recognized the need to change their business models to become more platforms, attracting more financial institutions and other lenders to their platforms. I don't think anybody's made as much of a move towards that as Kabbage has, who's actually branded their name Kabbage Platform, building out toolkits by creating data connections to providers like eBay, Stripe, and Yahoo, and so forth. I think there's less of an opportunity from a neobank perspective here, but certainly a lot of other opportunities from a lending perspective. But from a neobank or digital bank opportunity, I think the third trend in the platformification area, it holds a lot more promise. It's the emergence of fintech vendor platforms, companies like Constellation, Sandbox Banking, and Fedor Solutions to a lesser extent, who are helping to integrate some of the large vendor core platforms and enabling other players, especially the banks themselves and credit unions, because that's where Constellation focuses, to better integrate their services in and create more of a best-of-breed kind of an environment. But it's not the only space where this vendor platform is emerging. Also, players like Avoca have created platforms for digital onboarding and risk and fraud management. FI-SPAN in the small business space. NICE Actimize creating a financial crimes platform. And OnApproach creating an analytics platform. What this is doing, these are platforms where the buyers are actually banks and credit unions, financial institutions themselves, and the providers are fintech providers and other even larger institutions, larger companies themselves. So this is where I think is emerging in this fintech space is not just the platforms from the Amazons of the world, not just potential platforms from the large financial institutions, but fintech vendor platforms that enable the financial institutions to leverage these capabilities as well. So let's talk quickly about, just to wrap up, where are the NeoBank opportunities in banking? Well, contrary to a lot of the initial efforts, the opportunity is not in recreating the bank of the past by simply just eliminating branches. That's not the opportunity. The opportunity in the neobank space is by partnering with established financial institutions to reinvent the financial products. Is to leverage and capitalize on the changing consumer behavior, not simply from just a digital channel perspective, but by creating new products and services that meet the new emerging needs and developing needs of consumers. The neobank opportunities are also not by addressing the needs, supposed needs, of some 22-year-old who doesn't have two nickels to rub together and who's only worried about whether or not he's got enough money to spend on beer Friday night. The opportunity is in establishing capabilities with established consumers, the 30-something millennials, the Gen Xers in their 40s and 50s, to do what I think of as accessorizing their accounts. They're not giving up their checking accounts, but what they're looking for is more value out of their financial accounts. And the banks themselves are pretty slow to developing those capabilities. So it's the neobanks and emerging digital banks that offer the capability with the promise of creating new value, things like a digit and so forth that could optimize savings, things like that sit on top of the existing account structure where I think there's a lot of this neobank opportunity is coming from. Third opportunity is in leveraging the platforms for efficient distribution and scale. If you want to have an argument with me later, let's talk about Amazon, because I actually don't see Amazon as that big of a threat to existing financial institutions. I think it's mostly an opportunity for them and an opportunity for small emerging players as well. Think about Amazon's business model. Why in the world would they want to be a bank when they could make more money by being a service provider to banks? Ultimately, with a lot of banks competing on their platform, they'd be in a position to actually do what a Fiserv or FIS does today. They can be a digital account opening provider by opening accounts directly on their platform. Somebody brought up the lending opportunities on Amazon. Last year, I think they announced that they did $1 billion in merchant cash advances. Now, people will think of that as a threat to the existing financial structure. Don't think of it as a threat, think of it as an opportunity. Ask yourselves this, why was it only $1 billion? Is that because that was the total amount of demand for merchant cash advances among merchants selling on Amazon? I can't believe that that's true at all. It's probably a lot more likely that it was only $1 billion because that's all Amazon wanted to lend. That would fit their risk profile. That's how much they had to lend to those merchants. There's probably $10 billion worth of merchant cash advance demand among merchants selling on Amazon, and that number is probably going to grow as the platform expands. Amazon's not just going to walk away from that. They want to monetize that. They're going to help financial institutions and lenders and neobanks and digital banks meet that demand. And lastly, the neobank opportunity may actually come from actually creating platforms themselves. Pursuing a platform strategy. I've not seen that much here in the US, but in the UK, take a look at Starling. They're really getting a lot of traction, really pursuing that true platform business of being a magnet, a matchmaker, and providing a toolkit for the integration of providers and sellers. So I got 2 minutes if you've got any questions, or better yet, slings and arrows you want to throw at me, things you didn't agree with. And just last point before you take those questions, Patty, I publish a lot of this stuff that I talk about on a site called Insight Vault. If you'd like to subscribe, just text the word Insight to 345-345, which should be pretty easy for some of you to remember. It's probably your online banking password, so that's why I try to make it easy for you. So thanks. We got a couple of minutes here, and just see if you got any comments, questions, and don't be afraid to argue with me. I have 3 daughters, so I'm used to being told that everything I say and do is wrong.
You talked about being a magnet. So is your recommendation for fintechs to go directly to the consumers before they go to the bank's consumers through the bank? Because those are the 2 go-to-market strategy for fintech. What is your recommendation to become a magnet for the fintechs?
If you've got the money, go for it. Probably the worst call I ever made in my analyst career was LendingTree. Doug Lebda had come to our offices at Forrester. He talked about his idea of LendingTree, and I thought this is going to fail miserably. I thought he should just go to a B2B strategy, because I thought that banks would really value the capabilities he was building from a technology perspective. Walked out the door, told my colleagues, I said, this guy's going to fail miserably. It's going to cost him $50 million to build a consumer brand. I didn't ask the question. I didn't say, Doug, how much money do you have? He had the $50 million. If you've got the money, you can become a magnet on the direct-to-consumer market. But what you see in the past couple of years are so many fintech startups shifting from a direct-to-consumer to a B2B strategy, because that is an incredibly expensive strategy. So why not leverage the consumer and the awareness that the consumers have today among the banks. Now, that is changing. The numbers that I showed you before, with the NeoBank demand, I showed you the numbers that said how many have or would be willing to consider. I actually asked about awareness as well. And right now, consumer awareness among what I would consider to be some of the top 50 fintech vendors in the country, and I asked about neobanks, lending platforms, robo-advisors, insurance companies, international remittance players, fairly low among the younger millennials, Gen Xers, and baby boomers, a little bit more awareness among the older millennials. But if you've got the money to do it, but I think that's a real expensive way to go to market. So I'm over time. Pat, I'll let you try to keep on schedule. Thank you very much for your time.
Thanks, Ron. Now you know why Ron's regarded as one of the top 10 influencers in fintech. I didn't make that up. That is really a ranking that he has.